you were among the first people in private equity to flag a recession risk, several years ago, in fact. What are you seeing in the economy now?
Well, the economy is in reasonably good shape. I have been saying for a number of years that a recession is due at some point. We have one every 7 years on average. We're now 8.5 years into a growth cycle. So at some point, just like a broken clock is right twice a day, at some point I'll be right that we'll have a recession, but I don't know when that's going to occur. Right now, though, actually, the economy is doing pretty well. We're probably growing at more than 2.5% per GDP per annum. And I would say I don't see any signs of a real slowdown right now.
Some people are talking about synchronized global growth. Do you perceive that too?
I do think that there is more synchronization than before. I think the developed markets are actually doing quite well. Now the emerging markets are doing better, but really I don't see any recession anywhere in the world right now.
Does that surprise you?
It does, because historically some parts of the world didn't do well when other parts of the world are doing well. But right now, things are in pretty good shape. The deepest recession in the world in the last couple of years has probably been in Brazil. But Brazil is coming back slowly, but coming back.
What if Trump really is turning into a bipartisan? What would that mean?
I think bipartisanship is a good thing. Washington has become heavily divided in the last 20 years or so, and as a result, it's very difficult to get Democrats and Republicans to work together. If somebody can bring bipartisanship to Washington, that is deserving of a Nobel Peace Prize.
And do you think Donald Trump is that man?
I don't know. I know he's trying to make some efforts in that direction, and clearly we've seen some of the fruits of that. Whether that can be sustained, I don't know, but I think bipartisanship would be a good thing in Washington.
Are you encouraged by what you've seen so far?
Well, I do spend some time with members of Congress and trying to bring them together myself. I have a program where I interview historians in front of members of Congress, talk about American history, and we try to have Democrats and Republicans come together, and they do want to have more bipartisanship.
President Obama can still draw a crowd. Is it true that you paid him $400,000 to speak at Carlyle?
Well, I didn't pay him personally anything, but I would say that I did interview him. And we have conferences every year, and we've had former President Bush 41, President Bush 43, we've had Bill Clinton, and we've had Jimmy Carter. So we've had at our conferences all former presidents.
He did get paid, of course.
I don't know exactly what the arrangements were, but I suspect he was happy with the way we handled it, and I did a good interview of him, I thought, and he was very good. He's very well-versed on every issue.
Tell me what he said.
Well, I think he felt that he had done a pretty good job to help the business community. When he came into office, the recession was pretty deep, and actually he helped, I think, get us out of the recession with many things that he did, and a lot of job creation. I think he was very positive about talking about that.
Given the kind of criticism that Hillary Clinton faced for giving paid speeches, and the regrets that she has about doing that now, should former presidents be paid to speak?
Well, former presidents of the United States get a modest pension from the U.S. government, that's it, and they have their offices paid. They don't have any large guaranteed salary, and so I think people have to make a living, and I don't think there's anything wrong with being paid for speeches. You're being paid to interview me, right? So is anything wrong with that?
It's how I earn a living.
Right, well, people have to earn a living, so I don't think there's anything wrong with it. Now, if you've been a former president, you're not likely to go into government again and do anything that would be seen as improper because of you being paid a speaking fee. So a former president, I don't think, has the same issues that a candidate might have if that person is going to be president in the future.
David, you've described a private equity paradox. High prices, declining returns, accelerating inflows. It's an axiom, isn't it, that paradoxes can't continue indefinitely, or can they?
Well, sometimes paradoxes can continue for a longer period of time than people think. But what I was trying to say is that private equity right now is attracting enormous amounts of money. Why is that? Because over the last 5, 10, 15, and 20 years, private equity in good and bad times has outperformed every other asset class, and that's likely to continue. So right now, money is coming into private equity firms like mine from really all over the world because people think we can continue to get these pretty attractive rates of return.
Have you ever seen this level of interest in the kinds of assets that you manage?
I've been doing this for about 30 years, and I have not ever seen any of this level of interest. Now, everything will probably slow down at some point, and as Herb Stein, a famous economist, once said, if something can't keep going on forever, it eventually won't. But right now, the interest is very, very high.
Now, you announced almost a year ago that Carlyle intended to raise something in the order of $100 billion over the space of 4 years.
That's
for
correct.
New funds. At this point, given this level of interest, can you say with any certainty that you're likely to exceed that target?
I think we're certainly going to make that target. We might exceed it, but certainly I think we're going to reach that target, yes.
And is there any need to take advantage of the opportunity now, raise as much of that money in the short run, because you can't know what things are going to look like a year, 2 years from now, perhaps 3 years from now?
When economies slow down and people are nervous, it's hard to raise money then. Right now, economies are pretty good, and so people are willing to commit to people like us. When the economy does slow down and prices are a little bit cheaper, we'll have the money, and I think can invest at very attractive prices. The prices today, while high, are still reasonably workable, and we are able to get pretty good deals now as well.
Really?
That's correct.
You're among the few people in private equity who's ever said that to me.
Well, over the last year or so, our companies have appreciated in value quite considerably. So even though we're paying reasonably high prices by traditional standards, by doing things to make these companies more efficient, we are actually getting them to be more valuable.
How comfortable do you feel committing capital today relative to how you felt a year ago, 2 years ago, 5 years ago, given where valuations are?
Clearly, it's more expensive today than it was 5 years ago. Historically, the EBITDA multiples for private equity were probably around 8 or 9 times. Right before the Great Recession, they went to about 10. Now they're probably closer to 11. So it's expensive. But because people have, firms like ours have so many operationally skilled people now, former CEOs, COOs working on these companies, we can make them more efficient than before. And also, investors are willing to accept lower rates of return. Net internal rates of return of 20% is what investors wanted 10 years ago. Today, I think net internal rates of return of 15% are more than acceptable.
Less than 15?
Some people would be happy to get 14, 13. If I told you today I could get you 13% on your invested money, you'd be happy, right?
Well, it's better than the 10-year Treasury.
Right.
You started telling me a few years ago about the need for convergence between private equity and traditional asset management. And you're still talking about that.
That's correct.
But as of yet, I haven't seen Carlyle do anything meaningful in that regard, and frankly, I haven't seen it elsewhere either. Why?
Well, you have to remember, many of the businesses that we own generate carried interest, and that's something that as a publicly traded company, some investors don't like as much. They really want more fee income. And so what I've been trying to say is that more fee income-oriented businesses will probably be developed by private equity firms, and you're seeing some of that. Some of the big businesses that we own have more fees than our traditional businesses, but still, we're in the carried interest business principally.
Why not? Some of these traditional asset managers are under a great deal of pressure. Why not go and buy one?
Well, because it would be somewhat dilutive. Right now, they are trading at, let's say, multiples that are twice the kind of multiples we're trading at. So if you were to buy a publicly traded company, you would dilute your earnings. That's why we prefer that they go down in terms of their PEs before we buy them.
Or yours go up.
Well, that would be even better.
One last question for you, David. There's always a natural tension at a private equity firm among its potential targets over the degree to which you're a buyer or a seller. We've talked about it before. And for the past couple of years, Carlyle has been harvesting more than it has been committing. Is that changing?
For the last 5 years, private equity firms have actually raised more money than they have invested. And I think this year will probably be the 6th year in a row. That's probably because prices have been a little bit higher and than we would prefer, and also money has been available to raise. I suspect next year it might change, but right now we're investing a fair amount of money, about $16 to $17 billion a year overall. So that's a pretty good amount of money.
But you're raising more by selling companies that you already own.
We are raising a fair amount of money, but we're stockpiling it in the so-called dry powder, so when prices come down a little bit, we will be in really good shape.
And why do you think prices will come down next year?
Because if you go over it doesn't have to be next year, but at some point the cycle will come forward where prices will probably go down a bit, and that's happened historically over the last 50, 100 years or so. So prices, when they do come down a bit, firms like ours will be well positioned to take advantage of it.